Good day, traders. Stacey Burke from Stacey Burke Trading. Today, talking about the master pattern, the basic setup. And yesterday, again, some huge opportunities for traders on all markets in pretty much every session. But today, we're going to go over the master pattern from the beginning of the day. I know traders have asked me, what do I consider the beginning of the day? I base everything on New York Eastern Standard Time. The 24-hour cycle starts at 5 p.m. New York Eastern Standard Time. The new day begins at 5:01. I know people in the UK tell me, London's the beginning of the day and everything else. That's fine. These markets are configured to New York time. No discussion, no argument, nothing. It's just that's how it works. And today we're going to talk about the master pattern. We're going to talk about the Asian range, how the Asian range can typically set the tone for the day. There are some exceptions, which we did see this morning, and I'm not going to talk about the gap time trade, but we will get into that. The most important concept is the basic pattern. Traders are making this really complicated. I'm very specific to the time of day. I wait until that time unless there is a gap time trade, which, again, we'll go into that in the next probably couple videos. But Asia, 8 to 11. Can set the tone or the range for the day. If they extend the range outside of that, that can also give us some valuable information. If they extend it outside of the 3-hour window, all that's telling us is that the market is now extended, or again, if it's inside of a U.S. session high or low, we still may be inside of a larger consolidation. We talked about consolidations in one of the previous few videos. Important to master the consolidations. That's where everything works from when the new session begins. London 2 to 5 a.m., specifically the equity hour, when the London markets open up at 3 a.m. London or New York Eastern Standard Time, but that is when the London market opens up. And 8 to 11 a.m., specifically again at 9:30 a.m. when the equity markets in New York open up. I'm working from the higher low of the day. I'm looking for a really simple pattern. We talked about M's and W's. I'm looking for them to trap traders on trigger breakout traders. They may be type 1, type 2, type 3. Type 3 can be at the high of the day. Type 2 can be slightly just beyond the high of the day. Type 1 can be 25 to 50 pips outside of the range. Same thing for the W's off the low of the day. Double zeros and 50s. These are the main areas I'm looking for trade setups. So it doesn't mean the market can go up to 25. Of course, 25 can be the range extension locking in the high for a trade from 0 to 0 for 100 pips. Double zeros are the most important area on the chart for me. 50s can tend to be the mid-range or the extremes on the outsides of the brackets. And then engulfments, pin hammers. Time compression, a lot of questions about that. And what that's telling you is to pay very particular attention to the time of day. When a 15-minute bar ends and you're at the high of the day, it may have already been locked in on the 1 minute. I use the 1 minute charts when I'm at the high and the low. It's as simple as that. We'll look at some examples right now. So if we were talking about the master pattern, we go back to the beginning of the week and we just in simple terms draw our high and low of the Asian range. Now, if we narrow in a bit closer and pay attention, we see that 50 has acted as a possible level of support and bounce where that low reversed and we have a small pin through the low. But just in terms of simplicity, we'll talk the extremely high and low. Now, when the market gets into our new session, we'll blow this up. So we talk about three things that markets do. They break out, they pull back and they trend. They break out, they pull back and reverse to the other side. They break out, pull back, or stay without breaking out. They stay inside and they trade from high to low in a trading range. This violation of the high is the key, that area once they go above. And you'll notice they've come down 25 pips right at the beginning of the session at the high of the day. The point I'm trying to hammer home is that the master pattern, the consolidation, and then the timings for a breakout trigger, a stop hunt, whatever you want to call it, the pattern is still the same. The next day we redraw our consolidation. We have our high and low of the Asian range. We notice that at the bottom of the Asian range they've put a little micro W in. Okay, so they went down, they put a W in, they began to march up. The market breaks out in the gap time. So we know when the session begins, our new high of the day is there. again, the market puts in a high of the day in Asia. We have a low of the day from the previous night's U.S. session. We won't talk about the pump and dump, but this was a pump up from 50 into double zeros right at the end of the second hour for a fast 25 pips before the market began. Market goes into consolidation before breaking down in the gap time. Gap time locks in our W just below 50. So again, 50 could be our low of our box. If this is a 100 pip box, we could have 50 to 50. That means that we could be 25 pips above the range in a 100 pip box looking for our consolidation stop hunt. When we look at this chart on our 15-minute, you can see again the consolidation. The market before the end of the 12 candle window made a higher low. They break out of the range before reversing just below 50. So they break down below 50 and they begin the march back upwards. So they trigger breakouts, hit the stops, come back inside, they go vertical, hit the stops. Same pattern, the master pattern. Hit the stops, trigger breakouts, hit stops, whatever you want to call it. We'll get rid of this. And then they may trend the market or just pull it back into consolidation. So in simple terms, again, at the timing window, and again, we haven't talked about, I'm not going to talk about the gap time trade, but gap time trade, when they give you the gap time trade down there and they begin the march back up, I'm already thinking something up here. Now we can see that there were highs from the U.S. session. Just above that is 50 and the previous peak is 50, so we may be at something anywhere at 50 or 75. So again, the market breaks out in the first hour. At the beginning of the London hour, it goes higher, locks in a high, comes down. Traders may have taken this and shorted it. It comes down into the higher low at the end of the first 15 minutes, so 15 minutes down. And that market, if somebody had traded that, they may have gotten filled. They would have got their 25 pips, quick 25 pip scalp, and then the market proceeds to put in the higher low and comes back up at the end of that equity hour to retest the high of the day just underneath of 50, hitting stops, possibly triggering breakout traders, getting people chasing the trend long on the longer time frames. This breakout triggers again, 4 hour, 1 hour, maybe end of day, all that sort of stuff. Before engulfing and this sideways price action, that little hammer at 1047, bear hammer, begins the march back down, and they will come down usually at a minimum to the low of the session. So 50 on top, 50 down below, that's a 100 pip box. There's a good 75 pip opportunity there from high to low. So simple terms, master pattern. I'm not trading on the inside. I want them to pop the top. I want them to pop the bottom, whatever direction they go. Now the difference from a trend day, great example of a trend day. This was on Tuesday. We have a market that's pulled back from the high at the end of the session, gone into consolidation, and proceeds to auction lower, makes a lower high. We can probably redraw our consolidation down low. They lock in the low of the day and begin the march back up. We have our high and our low. Now, without getting too pedantic, you'll notice the first hour does not break out to the previous day's high or low. It's not at the high, it's somewhat at the high of the day. It's gone into consolidation. And this 4 bars, this first hour, this is a dead giveaway. The difference being is that the first hour we want to break the high or the low. So that first hour is critical. When the second hour, when the London equity market breaks out and breaks the high, that market now can proceed to go for an hour, 2 hours, maybe 3 hours. That is the beginning, that explosive movement at the beginning of the equity hour, outside of the previous day's range, in line with a potential breakout of the previous day's high. We could now be in the day zero. This is Monday, right? Monday, that's a big rectangle. We could now be looking at a possible trending scenario. So in a rectangle, the market goes into a narrow consolidation. It breaks out in the equity hour. Those are the ones that can continue to trend. That is completely different than a market that goes into consolidation and breaks out in that first hour, goes into consolidation sideways and reverses, breaks the highs, goes into consolidation, pulls back inside. So it's different than the master pattern. That is a trend. That is a breakout trade. The equity hour breaks out. There's a big difference. Looking at the NASDAQ, again, consolidation at 50 in Asia, London. We won't even look at the London trade. We can draw our high-low from the the Asia-London high-low. Once London printed, we can expand that range. There was a tight consolidation in Asia. They hit the high of that right at the beginning of the Europe window. Again, we'll redraw this just for simplicity. So they trigger breakouts, hit the stops, drop down, hit the stops, pull it back into consolidation, work the low in 3 pushes, begin the march back up. You'll also notice this market was largely between 50 and 50, and double zeros was median price. So when they layered up above at the open of the session, shorter time frames would have been looking to buy off double zeros for the move back through the high of the day. Now this first hour goes vertical. So they break through, they pull back, continue to go higher. There's no traders are looking for this. When this sort of breakout happens, we're still now potentially going back through the high of the previous day, the high of the week, the high of the month, whatever that may be. That market just towards the end of the hour gives us a nice little pin hammer. When I see that, I think pump and dump. It goes vertical. So if you're not in this move, which you very well could be, you could be in this move out. But now pay particular attention at time. We're at the end of the first hour and the market keeps going. So now second hour, I'm thinking this could go up for another possibly 30 minutes because they might bring us up really high and sell it off at the New York Open. They bring this market up higher for 15 more minutes. But when we get up above 75 on this particular pair, we get up above 75, we have a pin high this is at 4 minutes into the new hour. They go vertical again above that and railroad track. Engulfment right at the high, this bear pin hammer. Okay, so again, people say, where do I get in? There's our engulfment. We're above 50. So 50 is our major round numbers. They go up another 25 and engulf it. And then we get our bear pin hammer. If I'm not already in up here at the engulfment, I'll be getting in on the bear pin hammer as my latest fill. Breakout, pull back inside of that high. I want this market to break down below that low. But when I'm up this high, I'm not afraid to add size to this. Add size. If it breaks 50 now, I'm holding on. I might peel some off here and let the rest run. But this market, if we look at this, where the market started, double zeros, and we go back to the beginning of our day, that double zero area may be the middle of this move, which means I will put my measuring tool on here. And I will move this down so 50% is in the middle of that box. One more time here. This is the slow way to do it. But now we're talking a possible mirror image range expansion opportunity. The market gets down to 50. So we'll just move that down to 50. Okay, they've gone 25 pips above that range. And then the same applies on the downside. So it's gone up 150. We may get a move that goes down 150. This move exceeded that somewhat, but this may be the middle of the move. They go vertical. This is the value area, middle range of price where the move starts. They may go through that and then pull back. So that's why if you're taking money off, you want to be locking in profits. Do not let it come back, especially if you're chasing the move somewhere down low. Very important. But you'll notice even on the 1 minute, the same thing applies. If you're working on the outside, I'm looking at my 1 minute charts, and people asked about time compression. What that means is that I'm not just getting in. I'm not looking at price going, should I get in here? I'm paying attention to what time is it. If this is going into the next 15 minutes, it's going to go a minimum of 15 minutes. I get up to the next end of the 15-minute bar, we get an engulfment and pin hammer. That means that this new 15-minute bar could run straight down. And if that's the case, we could be going down now for the next 45 minutes to the end of that hour. New York opens and brings us down further. We see a pullback and the continuation all the way down. Master pattern. It doesn't matter which pair you're looking at. Again, the same process applies. I want a high and a low. I want a consolidation. Once the consolidation is there, in the euro, I had already a market that's breaking down. They go into consolidation and break out further. Now we're looking for something for the sell high in a broken down market. I talked about looking for shorts in broken markets. If you're going to buy strength, you want to be buying pullbacks in a bull market. These are the easier trades. You can scalp counter trend, but those are stressful trades. In a situation like today, we've got a market that's gone vertical in the pre-market. It doesn't matter. I just redraw my highs and lows. If this market is now in consolidation, today's a payrolls Friday, I still will be happy to content for this to leave it. I wouldn't be surprised if they pin the low and come back up tonight in the Europe Open. The payrolls announcement. So they might pin down. They could pin both sides and stay in consolidation and roll it over. I don't know, but I do know that until if this market doesn't break one level in the new session, irregardless of this high or low, I have no desire to be trading this market. You'll notice that the consolidation is tightening up, which is if you're trading inside here, you could be sitting there for the next 8 hours and it goes nowhere. So stick to the basics. I'm looking for the best opportunities. The simple stuff is where you can make easy money. If you're looking to try and show everybody your knowledge about the market and everything else, to me, you're missing the point. I'm looking for a market that gives me a simple setup for 25 to 50 pips. Gold, oil. Oil has been beautiful. It's been moving, crazy in the last few days. Process is the same. I want to know, what does it do at the timing window? It breaks out right at the end of the Asian session. They go higher. They give us a short trade right at the high of the day on the 1 minute. Bang, that's a 250 pip box. A 250 pip move. The trade at the beginning of the U.S. session on Wednesday, that went 600 from top to bottom, 600 pips. Next day, same process. We draw our high and our low. The market breaks that high just at the end of the session. But I'm waiting for them to pop the top, give me a short trade on the shorter time frame, and then ride that down until we get to a previous consolidation low, or we get time expiry in terms of an hourly rotation ending, a 15-minute bar rotation. But again, that's a 250 pip box. And you'll see the same thing happened in the U.S. We have a consolidation just prior to the U.S. session. They trigger breakout traders on the downside. They go back up to the top and hit stops. They lock it in and go vertical back down in a market that broke down from the high of the week peak formation. Consolidation, trigger breakouts, hit stops, trend the market. Consolidation, trigger breakouts, hit stops, trend the market. Very simple. Again, same thing. We have a consolidation that ended the U.S. session that they went up to and hit vertically in the beginning of the Asian session on oil. Again, I would just keep this simple. We're possibly in a 500 pip box. Now they've broken the low of Asia, but we're still inside that overall low. So if you're trading inside here, you could be trading and shorting this into the low. We may get something long back to the middle price, or even long back up to the high of the day. If this market breaks out, then we could be looking for a retest trade and a breakdown trade, possibly in the U.S. session. So hopefully you got value from today's video, traders. Smart money works on the outside. Sit and wait. Let all the consolidation chop up the dumb money. Stay on the outside. Keep it simple. Look for the M's and W's. You're going to get final flags, 1, 2, 3s, all that sort of stuff in the timing window. Hopefully you had a great trading week, and may the market.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.